Broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, and welcome to this Danielcode tutorial. Good evening, Janet. How's the sound, Terry? Can everyone hear me all right? We always have a worry about this. Terry says it can hear me fine, so we're in good shape. So good evening to all of you in the Northern Hemisphere, and good morning. In fact, good morning is for people in the east coast of Australia, and good afternoon to our friends in New Zealand. In fact, the clock has turned, and it's Good Friday morning down here in the Southern Hemisphere, the start of our holiday weekend. So glad you could be with me today. You'll be the diehards. We've got a great roll-up considering it's probably Easter holiday time for a whole lot of people. I had to take my daughter to the airport last night, which would have been Thursday night in Australia, about exactly where US Eastern time is now. And honestly, the major freeway, which is 6 lanes, in places 8 lanes, it was absolutely a parking lot. Just the traffic, the people going away on holidays, and good for them. That's a great thing to do. But of course, for us diehards, holiday just means you have more time to research trading, which is nearly my favorite occupation. So for those of you who are not on holidays, who are here with us today, great to have you, and lots of old friends here today. Akshay, who we haven't seen for a while, a couple of Allens, Albert, Alex, yeah, I haven't seen Alex, Alex Karoppa, yes, Alex, haven't seen you for a while. Brian, my friend Brian Baird up there in Wee War. Hope it's a bit cooler up there, mate. Bruce Wins. Bruce is up in Canada. He did a webinar, did a tutorial late last year. Hope that trading is going well, Bruce. If it's not, I mean, let me know if you're having any problems, because one of the commitments I make to our tutorial blokes is we'll keep following up until you've got it. Make sure that happens. Which is great. There's Don Maydell up in Canada as well. He's another one. Don actually came to the Waiheke Island, New Zealand tutorial in December. He's a great bloke. And Don, outside bars, eh? They're a pain. No doubt about it. We'll talk about those today as well. Harold Foos, my friend in Reading. Great man, a gold bug. Great man of God, Harold. Good to have you with us, mate. Janet. Going to see Janet at El Segundo in 2 months' time. Jerry Winter, our supporting brokers with us. Jerry, hi, mate. Jim Brown's new member. Jim Hughes, Charlie Barnes. Good Lord, everyone's here. Justin Woolley. Justin's one of our young traders. Came to the Waiheke Island tutorial, did a video tutorial before that. I think he's going to be very, very good. My great friend Michael Watt down in Melbourne. Michael, I know you've been absolutely up to your ears in it with work and drama and everything else, and good to have you with us. I was going to ring you last week, see how you were going, but you're obviously alive and well, which is great. I love, Pete Andrews. Yeah, Peter Andrews, the first bloke. He's my mate. He's a retired farmer in New Zealand, Peter, and great mate of mine. The first bloke I ever taught how to trade many years ago now, Pete. Still with us today, still going strong, still following the Danielcode. Great to have you with us, mate. Scotty Lancaster's a good client. Stephen Casterly up in Alberta. Mate, you are having a terrible time up there, I know. Things are crook in the oil patch, but keep on punching, old mate. It's not nice for you. I've been following a bit of that. Terry Roberts, Terry over in, not sure, Terry, you're a man who moves around. Sometimes you're in New South Wales, sometimes you're in Melbourne, but good to have you with us. Tom Chanovic down in Florida. Tom, great to have you with us. Here, Tom's a broker. Vicky Butterworth. I don't know Vicky, but boy, I love having ladies with us. We don't have a lot of ladies for some reason. I guess, it's interesting because It's interesting because in America, rather in Japan, I've got my totally lost. I was reading something. Forex trading is dominated by ladies. It's a real culture thing, but not so much in US and down here. I guess we don't have a lot of ladies with us, but everyone's coming in now. Lots of late arrivals today. Not surprising. Dan Dart's a new guy with us. And Mike Mitzi7, Mike Mitzos, a super gun trader. Good to have you with us. Mike, let me know how your trading's going. You're a pretty famous tutorial graduate. In fact, I invoked your name yesterday talking to a new guy who's thinking of coming a tutorial. He said, what can I expect from the tutorial? And I said, well, depends how hard you work and how much application you have. But I can tell you, Mitzi7, that's my friend Mike from Chicago, posted in the forum that he'd been trading for 10 or 12 years and came to doing okay, up and down, but okay. And he came to a Danielcode tutorial in May last year at El Segundo, Los Angeles, and he posted 5 months later that he'd made 20, yes, that's correct, he said, more than 20 times the fee. And as my tutorial fee is $7,500, that means he made something in excess of 150,000 in about 5 months. So he's one of our stars, and that's one of the things that if you're really good at this stuff and want to be better, come to a tutorial. We can do for you what we did for Mike. Janet is the person from Alberta, near Calgary, Alberta. I don't know, Janet, Steve, I know he works in the oil patch. I think he drives a very sophisticated machine. And if you're up there, Steve, if you got this note, you can type in the questions box if you're from Alberta, near Calgary, Alberta. We have quite a lot of Canadian clients, so that's good. Okay, let's move on to the events of today. I want to thank Terry for our banner today, as usual, when traders fail. And we've got a very unhappy looking trader there with tears coming out of his eyes. And of course, the tears have dollar signs in it. This is Janet. This is from Steve. He's in north of Fort McMurray. In north of Fort McMurray, from Steve Casterly. Janet, if that's anywhere near you, you two can get together and have a chat about Danielcode trading. Okay, thanks, Terry. Great banner. Thank you. 2016 coming up, folks. Our next tutorial, 24 to 27 May in El Segundo, which is it's Los Angeles. It's about 15 minutes from the LAX. And you've got some photos here of Manhattan Beach. Jerry loves Manhattan Beach. That's about 5 minutes in a cab from where we hold the tutorial, which is the Hilton Garden Inn at El Segundo. Great, lovely part of the world, actually. It's, it says Janet, ha ha ha. Okay. It's amazing that, you're only minutes from virtually the heart of Los Angeles, but boy, you could be anywhere in the world down at Manhattan Beach. It's a great little village. So we've got the online booking forms for accommodation at the Hilton Garden in El Segundo. That'll be up on the website on Monday or Tuesday, and also I've updated the syllabus, which will be coming out to all of you on Monday, and do let me know if you're coming. Be happy to have you there. Okay, let's talk a bit about trading and some of the problems. We've got a few new members, quite a few actually, and just going through some of their questions and comments. It's clear that there's a whole lot of confusion in people's minds about trading. So trading goes in stages. It goes from very basic to very advanced and sophisticated. This chart you're seeing now, this is a fourth seal chart, which was how we forecast the turning point low of gold, and those who've been following the Fourth Seal will know that Frank DB, who helped me prepare these charts and reports, pinpointed the low in Huey, which is the unhedged gold miners index. It's highly correlated with the price of gold, and Frank pinpointed that beautifully late in 2015. So now this is very sophisticated stuff. This is the sort of stuff you learn at tutorials, and it's about time and price. And I guess where the Danielcode is so different from all other trading programs is that we have very, very specific price targets. And there's a numerical matrix that we use to create these targets. You can see these price targets on our members' charts and in the fourth and fifth seal reports. And we see markets going, as Frank's written here, incredible Danielcode precision. And this, incidentally, is a 6-day chart. Each of the bars on this chart are 6 days, and it's still absolutely very, very extremely accurate. And on the daily charts, of course, it's probably even more so. But that's one of the great differences in the Danielcode, is the precision of time and price. And I'm going to come to that in a moment. But this is the advanced stuff. For you people who are starting to trade, don't worry about this and don't get caught up in it. Even I say to some of our people who've recently done tutorials, there's a tendency to get carried away with the forecasting and, this sort of dramatic stuff. And it is dramatic. It's very dramatic, but it's a lot of work, a lot of charts to maintain, a lot of spreadsheets to back them up. And that's not what you need to be starting on. The business of trading is the business of making money. That's what we're here for. And that's how you measure your success in this business. And with all this forecasting, I mean, it's spectacular, and we've made some amazing calls over the years. Many of you will remember, all the way back to the 2009 low in the S&P. We call that to the day and a couple of ticks. The 2014 high, we had that a year before it came about. This recent high in the S&P, this big low in gold and Huey, all of that. It's very, very interesting. It's very exciting. But the reality is, if you're going to be a forecaster yourself, learn to trade first, because it's the daily business of putting your trades on, putting your stops on. That's what makes the money. Okay, and you'll find trading is a whole lot more enjoyable if you're consistently making money. Let's move on through some of the things we're having. We've got John with us. Oh, Luke's with us too. Hello, Luke. Good to have you with us. Had a couple of emails from Luke. Let me see. Where is John? Here he is, John Horman. John, hello, mate. John's a insurance broker up in New England. Which is in the north of New South Wales in Australia. It's a lovely, lovely part of the world. I spent a lot of time up there over the years, John. And it's a beautiful place. And, of course, we have these problems with you people who are getting started trading. And you can see from this screen I've got up here, getting started, technology confuses. Well, it sure does. And what you're seeing, actually, is the new screen that Trade Navigator have put out. And believe it or not, doesn't look anything like a Trade Navigator screen to me, but this is their new version. You have two choices. This only came to light today. John was emailing Terry saying, can you get me started? Can you get me set up? How do I add these programs? And Terry kept saying, click on the blue telephone icon. And John came back and said, what icon? And no one knew what he was talking about. And then eventually we saw this new, the dark version that Trade Navigators put out. And believe it or not, this over here is now the new telephone icon. It's replaced the telephone icon, which would then beg the question to me, what's this icon over here? which appears to simply be the reverse of the telephone. So what does this mean? Does it mean you can use your telephone to get your end-of-day data, or to activate your Danielcode programs, etc., and then presumably this is only in the dark theme. This is the dark theme. The other one is fine. But if you do decide you like the dark theme, you want to think about this. So then what does this icon mean? This means you can undo the telephone call, does it? No, it doesn't. It means it's something to do with the sizing. But I just make this point that for those of you who are starting off in your trading careers, there's an awful lot of things that are new, and your mind needs to adapt to them. I've also had some questions about correlations, and why do we do signals for the Huey? I wonder if Rose is with us today, or has she gone on holidays? Let me see. Are you with us, Rose? Rose is not here. Okay. Well, others I know have this problem of why do you create signals in the Huey? Well, the Huey is it's an index, and you can't trade it with futures, but you can trade it with options. But it's the index of I think it used to be 25 gold miners who do not hedge their forward production, and as such, it works as a proxy for gold and for silver, because gold and silver themselves are so highly correlated that a trade in gold can be executed in silver, and a trade in silver can be executed in gold, and a trade in Huey, a signal for Huey, can be executed in either gold or silver, so long as it is elected. And by elected, I mean this is Thursday's chart here, and this is this is Wednesday's bar. I did this yesterday, and this is Wednesday's bar, and to be elected it had to trade 2 ticks below the setup bar, which is Tuesday's bar. So let me bring that up on another chart so I can see what's happening in it, and here it is. So we had that bar there, Tuesday's bar. The low of that was 1242.8. So you sell that at 1242.6, and down it goes. And at the close there, it was worth about $2,200 per one contract. And to Bushy, we persisted. Thanks. God damn it! Yeah. We can't say "God damn it" to Terry because that's considered a very offensive expression in America, John. But to us, it's like saying "good day." Okay, us being Aussies. So let's move on to the next chart. So that was the gold chart. So this is the silver chart, and as you can see, they look almost exactly the same. But they don't have to be the same in quantum. Don't make that mistake. But what they are is they're almost always the same in direction. And if you look at this silver chart, it's the sell. If you'd taken the sell in gold and wanted to execute it in silver, because we had the sell for gold on Wednesday. But you could have executed that in silver if you'd wanted to. Those of you with bigger accounts who don't mind the margin, same thing, and it's made 2,800 to today's close. But you can see what I mean by correlated. Some of these markets are driven by the same forces so much that they will tend to move in the same direction very, very frequently. A high degree of correlation, something in the 95 plus percentage. So if you see a signal in Huey, you can execute it in gold and silver. If you see a signal in gold, you can execute it in silver. If you see a signal in silver, you can execute it in gold if you wish, and if the trade is elected. So that raises the question, why do we even do signals for the Huey when you can't trade it in futures? And the answer is that sometimes the various pieces of the analysis that go to create a buy or a sell suggestion in the Danielcode signals don't just set up exactly in one or other of these markets, but they will set up in Huey. And you can get some very, very good trades. This is called D2, or correlated data is the expression. You don't need to bother yourself with it. We're simply saying that there is another market that is so close to the markets we want to trade that the signals from that market are valid. Okay, so that's what correlations are about, and that's why we create signals in the Huey. And this is the Huey, and your chart should have changed by now. And we've still got this nice big circle down here, or oval down here, which we talked about previously. This is way back in December 2015, where Frank DB started buying gold because he was so confident that the Huey had bottomed out. And this gives a interesting position of it that, in fact, it did just go and do a false break here, and then it's off to the races. And this massive rally in gold and Huey has been worth a great deal of money. So well done, Frank, and well done, the fourth seal, which is how we identified that as a significant likely turning point. Move now to this part of the chart, if you would, here, folks, where I put the cursor, and this is what the Huey did on Wednesday. Let me just get my highlighter tool, which is called a spotlight, and it's this down bar here that I want to show you. This is what Huey did on Wednesday, and today it's had a little rally back. But this is intended to show you what happens with these correlated markets. They all tend to move in the same direction, but the quantum of what they do is different. So, for example, the gold trade was actually much better than the silver trade because they made about the same sort of money, but the margin for silver is many times higher than the margin for gold. So correlation and correlated markets, remember that. Let's move on now. We have a lot to go through today. More correlations. These equity markets, the S&P, the Dow, the Russell, the Nasdaq, and Germany's DAX are very highly correlated. A signal in one can be executed in any other. So if you like to trade the Dow, you can take signals from the S&P and trade in the Dow. If you like to trade the Russell, you can take signals from any of these markets and trade them in the Russell if the trade is executed. Sometimes some of the softs, the coffees and what we call the softs, and some of the grains are sometimes correlated, and sometimes they're very highly correlated, but that's not a causal relationship. Those correlations between softs and grains, they are correlations that come and go. They're not fixed correlations. So you may observe that and say, well, I'm onto something, but we have lots of people who find exciting things in their trading, but we're going to talk about that in a little while. And basically, unless you can go back and test that proposition over quite a long period of time, it's probably just a happenstance. In other words, all you are seeing is correlation, not causation. But these S&P, Dow, Russell, Nasdaq, and Germany's DAX, they are so correlated that you can take a trade in one and trade it in any other. So for those of you, it's been interesting, the conversations with people I've had this week. I've talked to people who've been trading a long time. They've had their ups and downs, but mainly their downs. And that's a really, really common thing in trading. That's what I hear from almost everyone who's been trading. They've had some good trades, bad trades over a period of time. They finish up losing their account, losing their bank. And the common wisdom in this business is that 90% of traders will lose their starting bank in the first 90 days of their trading. My observation is that 99% of new traders will lose their starting bank in the first 30 days. In other words, nobody seems to be able to trade properly when they start, and there are some very, very good reasons for that. This business is enormously complex in many ways. It has a language of its own, which you have to learn the basics of the language. They talk about longs and shorts and backwardations and correlations and all sorts of things. The markets all have their own codes. These markets trade at different hours. They don't trade in the same basis. Some of these markets have 1 decimal point, some have 2, 3, 4, some even have 5. Other markets don't have decimal points. They have that little arrowhead, which is called a carat. It's a French word. That's the correct expression for it, I understand. I may not be pronouncing it properly, not being a Frenchman, but that is the little arrowhead, and it has the numbers after the carat are the ticks, and you see that in markets like T-bonds and some of the grains. And T-bonds trade in 30 seconds of a point, and most of the grains trade in a quarter of a point, even though they use the carat symbol. So the reason for all of this is basically historical. There have been a number of different exchanges over the years, but the most common one is the CBOT, the Chicago Board of Trade, and the CME, the Chicago Mercantile Exchange, were the two mega exchanges. And they had totally different methodologies of labeling markets and the price that went within those markets. And they had different traditions of holidays and trading hours and everything else. And those two exchanges have now merged, but a lot of those differences are still apparent. So some of this stuff is history. Some of it, if you have the passing view that it's designed so only brokers know what they're talking about and the poor punters never know, you might be partially right, because it seems to me it would be terribly easy. We've been forced to decimalize everything in Australia, our currency, our roads. We now have for many, many years, let me tell you, had kilometres instead of miles. We've had to get rid of furlongs at the races and turn that into metrics. So, I mean, it would be really, really easy to convert all that stuff into metrics. But United States is one of the few countries that has no intention of converting to metrics. So anyway, be that as it may, there's some of the things that are the problems. But in talking to some of our newer traders, these are some of the issues that have come up. And you don't need to know about the fourth seal when you're a new trader or forecasting. And in fact, all you need to do is start with the basics of trading, and this is where you make the money. You need to know the direction, should you be trading a buy or a sell. You need to know where to enter most of these signals. In fact, all of these signals that I use are conditional. So if the market is going down and it's setting up at a blue line, that doesn't mean buy at the blue line. It means that we do our analysis of the various indicators that go into that signal, and we say we believe that this is set up for a turn. And we itemize why, the reasons why that is of the various indicators. But then we always need one more thing. We need the market to confirm that it's thinking what we're thinking. We're never so presumptuous as to be buying or selling on limit. And I know a lot of people do, particularly short-term traders, really short-term traders, but it's a very, very dangerous practice, because markets set up at the Danielcode numbers all the time. You can get a turn where the other conditions are satisfied, or it can ignore it and go to a subsequent number. We're going to have a look at one of those examples in a moment. The main thing for those of you who are new to trading is please, please, please trade a sim or practice account. Sim is shorthand for a simulated account. You get some practice money. Trade Navigator does this for you. Almost all charting programs will let you trade a practice account, and you trade that until you are confident in the system and in your own execution. And do not, I beg you, risk real money until you've graduated from that learning curve. Now, I've had an awful lot of people over the years say to me, oh, look, I'm going to trade for a small amount of money because, my brain doesn't switch on. I need to have some money at risk for me to concentrate. That's really wrong, because if you've got any money at all involved in your trading, you have a degree of emotion. You're invested in the trade, and greed and fear always are lurking in the background, ready to jump out and bite you. So if you have any money at risk, you are emotionally invested, and that is not the best analytical position to be in. If you're simply trading a sim account, you can get rid of a lot of that emotion and fear, and you can look at your trading objectively. And you should trade a sim account. I can't tell you how long. That's up to you. But, for newer traders, that's a minimum of 3 to 6 months. And I promise you there are no shortcuts in this business. And the only shortcut is the one to poverty. And hundreds of thousands of people come into trading. They think it's a game they can learn from books or the internet. And I have to tell you that everyone makes that mistake, and I made it myself. And there was a particular reason I made it. I'm an attorney, and I've been an attorney now for, Jerry, over 40 years, right? Getting pretty close to 50 years. A bit about that business too. But in most of the important disciplines in life, you learn from written material, and the law in particular, medicine, engineering, all of the great professions, you learn from written material. You learn from books. You learn from what's been done before, from what's been decided before, and what's accepted as best practice, as they say these days. These days, I was talking to Terry a couple of hours ago, and I think it was about you, John, and your goddamn it email, and he said I was having FaceTime with my wife. And I said, crikey, what does that mean, FaceTime? Were you doing her makeup or something? And Terry told me it doesn't mean that at all. It's something to do with these mobile phones. Apparently you can talk to someone and press a button, and then you can look at their face, and that is called FaceTime, which I didn't know. So some of these new expressions are a bit out there. Anyway, so what you've got to do is think that the fact, and it's a sad fact, trading, I believe, is one of the very, very few games that you can't learn from books and you can't learn on the internet. Now, there's some very interesting reasons for that. If you think about the parallel with law or medicine or engineering, all of these principles that become enshrined have been subject to various levels of peer review. In other words, if we think there's some legislation that's the new law, it'll be tested in a court. And that decision will then be tested probably in a higher court and a higher court. And by the time it becomes established, it's been reviewed objectively by a number of very, very highly skilled and highly trained minds. And that's not what happens in trading. And of course, as I am a lawyer, and that was my background when I took an interest in trading, I thought to myself, I can learn this from books and from going to people's seminars and lectures. And I spent a small fortune, a not so small fortune, on books and courses and trading gurus, and some of whom, really do deserve to be in jail. Others are terribly genuine, but I have to say that it didn't work for me. And eventually I was forced on a quest to either find out what really made markets move, or else stop wasting all my time on trading and get on with my practice of the law. And that was the course. After quite some time, eventually I started to find the Danielcode, which started this whole new life that I have and many of you share with me. But if you think about what you're reading about trading or learning in a webinar or a tutorial or paying someone to teach you, that has not been stress tested. That's the problem. When you look at the books on law, medicine, engineering, pharmacy, so on, any of the great established societies, and disciplines, they have been stress tested at higher and higher levels. Some guy wants to teach you about trading or write an article about trading. All he's actually giving you is his own personal experience and his own personal view, and you don't know how far that's been stress tested. Now, those of you who have been to a Danielcode tutorial will know that I keep waving around my Fractalian program, which allows us to test 14 or 15 variables in any market over vast periods of time. And it's completely mechanical. I'm going to show you some of the output from that as we go. And Michael Watt down in Melbourne, my friend, has been working with me to make this better, Michael, and I hope our clients will be very excited when they see what you've managed to develop, and we'll see something from you, hopefully, in a few weeks, mate. We might get the start of the thread at least. But everything I have as an idea, I stress test it over sometimes up to 58,000 variables running in a test in a machine-tested environment. So that's the difference. Don't forget, when you read someone, you're really just relying on their reputation, which can be as silly as he's an analyst with JP Morgan. He might be a very good analyst. He might be absolutely bloody lousy. My experience is most of those guys have their own ideas. Some of them are, for example, tell you a little story, Elliott Wave people. And we had one of the bosses of the Market Traders Association with us a few months ago down here in Australia. They're the people who set the exams that you need to take if you want to get the appropriate license in the United States. And for many, many years, Elliott Wave has been a compulsory subject. I proved to him that Elliott Wave is, frankly, it's a virus. It's not real. I know the guys who promote it believe in it. I'm not suggesting they don't. They see things that no one else ever sees. The last I heard, the Market Traders Association, it's no longer, after years and years of forcing everyone to learn this awful thing, Elliott Wave, they've stopped doing it. They've now accepted that it's not valid. Boy, how's that for a big mistake? That's the problem with trading. You don't know what these guys' backgrounds are, and you don't know how long they've tested it for. And some of these systems, like Elliott Wave, are incapable of being back tested because they are subjective and they have alternate constructs. The alternate to this count is, in fact, the opposite. Its beauty is in the eye of the beholder. So that's the problem. You can't learn this stuff from books or the internet. You can, however, learn it from the Danielcode because we've proved this stuff so rigorously. But stick with your sim account, please, as long as you possibly can. The longer, the better. Look for your next question here. How often do I look at the charts? There are people, Mitzi7, who's with us today, who are great intuitive traders. I think, he's on his charts all the time. He does very, very well, but he's one in a million. The reality is, if you're sitting there looking at your charts all day, I will almost guarantee that you will be forced to take action. It's a reflex action. It's like, the problem with cats, they have a strike reflex in them. If that's triggered, they can't help themselves. And it's the same with traders. If you're sitting there looking at charts all day, I'll almost guarantee that you'll be inclined to do something which will ruin your system. So get rid of preconceived ideas about what the market will do. I've talked to people today who said, look, I've been trading for years. I think this market's going to go up for this. That's not your job. Don't think about that stuff because you can't prove it. And we have no foreknowledge. Your job is this. If this happens, do that. And that's how the Danielcode is structured. We have forecasting. We have signals that indicate what the market may do tomorrow, but we have no foreknowledge. We don't have it. Nobody else has it. Anyone who suggests to you that they have foreknowledge is telling you fibs. So get that out of your head. You don't know what the market's going to do, and it's not your job to know what the market will do because that's unknowable. Your job is that the way we set this up in the Danielcode, we say, if the market does this, then you do that. Okay, so we're reacting to what the market does, and we can put our orders on before the market starts to trade to say, if the market gets to this number, we want to be long, we want to put our stop here, and we're happy to accept that risk, which we can manage and calculate. That's a vital idea. Everybody I talk to has an opinion about what they think the market's going to do. That's not your job. And even when we talk to you about long-term charts, we'll look at the 6-day chart to update ourselves with where the S&P and are. Augustus, who's Augustus Teller? How did you get this good, dear John? How did you become an excellent investor? Well, mate, thank you. And I tell you the short answer. 30 years of 100 hours a week. And certainly the last 20 of those years have been exclusive. In other words, I don't do anything else. I am totally and utterly invested and curious about trading. The rest of the world goes on holidays. I say, yippee, I can look at my charts, I can run numbers, I've got 100 harebrained ideas now. I want to find out which ones I can prove and which ones I can't. So I am dedicated to this proposition of trading in a way that few others are. And when you become obsessed with something, if you have A, the intellect, and more importantly, B, the tools to measure it. Remember, everything to do with trading, if you can't measure it, you can't prove it. If you have obsessed enough, you have some intellect, and you have the tools, you can prove which of your ideas are valid and which ones are just a casual association with the market. And that's the key to that. So remember also, becoming a good trader takes time. One of the guys I've been talking to in the last couple of weeks, a new member, wants to know, how much can I make? What sort of percentage can I get? Look, the answer is a lot, but it depends how good you are, and you won't be good until you've practiced. This is a game. I mean, I'm a lawyer, I've been a lawyer for 40 years. Let me tell you, learning to become a good trader is very considerably harder than getting yourself a law degree. Okay, and that takes, it used to take 5 years. I think you can probably do it in 4.5 years now. But that was 5 years full time and working in the business as well. Okay, becoming a very good trader is considerably harder than that. And the number of very good traders, let me tell you, there are absolutely very, very few of them. But you can get there. I can take you there. I've done it with many people. Plenty of proof of that on the website with testimonials from people who've done it. But to be honest with you, not every one of my students becomes a good trader. Some of them don't have the application. Some of them don't stick to it. Some of them, get disappointed and have a bad trot and give it away. And of course, the reality about trading is you don't learn much from a winning trade. You have a great winning trade. You say, wow, how clever am I? Isn't this great? Blah, blah. You only actually learn about trading from your losing trades. So if you have a losing trade, obsess over it. Learn how you could have done it better. Learn if there's any reason why you shouldn't have taken that trade. And sometimes there's just no reason. Losing trades is part of this business, but your risk management, did we optimize the risk management? We got all of our options available? All of this takes time, so don't be impatient. Start on the journey. There is no better life than being a trader, I promise you. You're your own boss. You can trade from anywhere in the world that's got an internet connection. And you can trade when you want to. You don't have to trade all the time. You can start when you want to, finish when you want to, go away, take a holiday. The markets will always be there for you. And when you've done some of these things and feel that you're ready to step up, come to a Danielcode tutorial and learn about trading time and much, much more. One of the things on the Danielcode website, which we're going to go to, is that it is a website that is optimized for safety. It is not optimized for profitability. So the signals and the techniques we talk about on the website are pretty basic. and we try to keep them with it, optimize them for safety. So on the website, we actually don't talk at all about time trading and time trading signals. But in fact, one of the major differences, the things you'll learn at a tutorial, is trading time. And it's amazing and it's marvelous. And I hope some of you will take that opportunity to either come and see me in El Segundo in 2 months, and for those of you who've already done a tutorial, come along and upgrade your skills, update your skills. It's always new. Every tutorial there's something new. Alan, can people that work trade just as well? Absolutely. There's only going to be one difference, and one single difference between people who want to sit there and watch the screens all day and people who don't. Now, I hate watching screens, and I'm terribly busy with everything else in the business and my research and correspondence and everything else. And how I trade, I put on my orders, I put on my stops, I go away. I don't look at the market again till after the market's closed. It does its thing. I have my stops on. I know what my risk is. I've accepted that risk. That's it. Let the market go. In fact, you will, for almost 99.9% of people, that is a better way to trade. There are some highly intuitive people like Mitzi, I was telling you, who can optimize just where to get in and get out. They've got a terrific feel for markets using Danielcode tools, of course. But for most traders, they do a whole lot better when they go to work and don't look at the markets. And if you haven't got a job to go and play golf. Put your orders and stops on, go away from your computer, just let the programs run. And one of the most vital parts about trading is your stop loss management, because your stop loss determines initially the risk you take on entry and the risk that comes as you move along. So there are various types of stops. There are fixed stops, which is what we use on the website. That your entry goes there, your stop goes there. If the entry's triggered, you're in a trade. Your stop's there. It's an if-done stop. It's valid. Then you have trailing stops. For some of our trading programs, the blue line trades, we want that stop to move along as the market moves along. So we use for that program a 2-bar trailing stop. And that is if you were long or in a bought position, the market's going up, you would have your stop underneath the lowest low of the last 2 completed bars. But there are variations of that. You can run stops based on a percentage of the previous bars. One of the programs I use a lot works on percentages of the previous average trading range for 1, 2, 3, 4, 5, as many days as you like. You can vary all of that. And that's very interesting. You can have, instead of having your stop in a fixed position, you can have a fixed dollar stop. You can say, I want to risk $500 on this trade. I'm going to put my stop $500 away from my entry. And you do that by simply working out or finding out from the CME website what's the tick value, and you divide $500 by the tick value, and that would tell you how many ticks away you have to put your stop. And you can put that on a spreadsheet and it'll work it out instantly for you. Or you can use a trailing dollar stop. So you can say, I'm prepared to risk $500 or $1,000 or $1,500 when I enter this, and then I'm prepared to maintain that risk. So as the market moves up or moves away, the stop moves with it, always holding that value away from the highest point in the market. So if the market turns around and comes back, your trailing stop will never move in the opposite direction, and you'll get stopped out, and that risk, the dollar risk, moves with the trade. And the things you need to know is when to use each stop. But risk management is the name of this game. I talked to a chap today who was telling me that he's been trading for a number of years, and I know you won't mind me using this example, Dan. But he, had a trade, and it might have been the NASDAQ or something, and it went on to make $80,000. He had a reasonable number of contracts, and but he got out too soon, and he was very frustrated with that. And he got stopped out, and then the trade went on to make a great deal of money. So he said, on this particular occasion, I'm not going to get stopped out again. So instead of having his stop in the right place, he moved his stop away. He finished up losing a great deal of money. Okay, stop losses occasionally and not often will do something unexpected, but almost all the time, if your stop is in the right place, it won't get hit unless the market means it. And if the market means it, you want to be out of that trade because it's going the other way. Now remember, none of these things are certainties, they're all probabilities. But what we do here at the Danielcode is we work to identify the high probability moves. If you're putting your stop loss underneath the high-low of the setup bar, the low of the setup bar if it's a buy, that stop tends not to get hit unless the market means it. But when we submit that suggestion to a long-term test on our Fractalian testing machine, we find that optimum results come from having a bigger stop than that. And I'm going to show you what it in fact means. So let's hoist that in and move on. And here is the reality of trailing dollar stops. Your screen should have changed. What I've done here is I went into our Fractalian program so that I just have something fairly current for you. I asked it to run T-bonds, this is US T-bonds, from the beginning of the year to the beginning of March. January, February, a couple of months. Not a lot of data here. We can run this over any amount of time we like, but it just takes longer to run. And once we get up to using, 40 or 50,000 variables, as my friend Michael in Melbourne knows, it can take a very, very long time to churn through them all. But here's interesting stuff, because, you start off, and I said to the program, tell me what happens if we use a trailing stop of various amounts from $500 up to $3,000 as a trailing stop. That is, if we're saying 500, we'll have a $500 stop on entry, and it will move up as the market moves up, or move down as the market moves down, always $500 away from the highest or lowest point. And this is a big market, a pretty slow and casual market, T-bonds. And look what happens with a $500 stop. Over the 2 months, all you make is $21. You had 27 trades, 44% win, which means that more than half of these trades failed. What I've used for this setup, this 111, is I'm telling the program to just use its base settings. I haven't optimized for the best settings. I'm saying just use your absolute base settings, but tell me the only variable I want to know about is these stops. So then as you move to $1,000, which seems, you think that was pretty good. I'll just get a highlighter here for you folks. Bear with me. Here's the highlighter coming. I call it the spotlight. It went into this row across here now. There's $1,000. It loses money. It has a 60% win, but it loses money. You move up to 1,500. Still doesn't make much money. Now, T-bonds isn't a big margin. 1,500, you're getting pretty close to margin there. $2,000. You've made 1,109. This is what you earned. This is the size of the stop, dollar stop. This is what you've earned in the 2 months. And then, as you can see by now, look up the top. If you use a $3,000 trailing stop in T-bonds per one contract, you've made $9,000 over 2 months. You've had a 95% win rate. In fact, you've only had one loss out of 19 trades. Now compare that with what happens with a $500 or $1,000 stop, or even a $1,500 trailing stop. Okay? You can make, I forget what the margin is on T-bonds, but it's not very much. It's one of the smaller margins. You're talking about astronomical figures here. This is 2 months trading. I'd even go so far as to see, Jerry, if I've got a margin for T-bonds here. Some of you guys might know it. Feel free to type it in if you do know in the questions box and let me know. In the meantime, I'll have a look what I can find. Bear with me, shouldn't take terribly long. T-bonds, the margin, initial margin. This will be out of date, but it was 3,700 or thereabouts. So when you get up to this sort of number, you're talking about 100% of margin as your risk. Now, intuitively to me, that would just seem wrong. Like so many of these things in trading, what you think is wrong. And when you subject it to a long mechanical test with the machine doing all the work, you find out that it's wrong. And that's the big difference, that we have the ability to back test a lot of these ideas before we tell you about them. So that's one. There's another one that you wouldn't, intuitively, you wouldn't think of using close to 100% of margin as a trading stop, but that's what works best. So folks, here's what we'd like you to do. If you're not already finding out about the marvels of the Danielcode, please to help yourself to a free trial. It's on the website. You just click on the banner that says free trials. You'll get set up your username and password. Send your username to Terry at support@thedanielcode.com, and he will switch you on for everything. And here's our compliance statement. Please be aware trading is risky. Risk of loss in trading is huge. And for those of you who have not learned how to trade the Danielcode way, it's a whole lot bigger. So you guys who are good Danielcode traders, you've overcome most of that barrier. But I always like to make sure people are aware, do not trade with real money until you are sure that you've got it and know how to handle it. And you can do that at the website and other ways. This is just part of, here was the run that I just showed you the results of. As you can see how this thing goes. This is Fractalian running. It's going to run through a fairly small sample here. This is going to run about 5,700 variations of the variables, and we've got 1, 2, 3, 4 variables in this particular test. So this will take 35 minutes to run, and eventually it will tell us what are the optimum settings, and that's how we get this stuff. Okay, let me get rid of that because it's going to sit there on the top of our screen and be annoying. So we'll cancel that and close it. Here's a chart of the US dollar, guys. As usual today, I'm going to run out of time. We're very close to 1 hour already, and I don't want to go over time today because I know you folks, it's a holiday now, weekend, you get a few days off. I'm going to keep the other part of this tutorial with your approval, folks, because I've probably got another 40 minutes at least that I want to talk to you about. But I've just got so much material I can't get through it in the time. But I want to show you, this was one of the other interesting feedback from our clients saying, when I saw the chart, this happens to be DX, the US dollar index, you had all these blue lines on it, and then when you talk about it in a webinar, the blue lines have gone. And you only show the last one. Why is that? Well, it's just a visual way of showing it, but this is the US dollar index. And this bar here, the outside bar that my cursor is on, that's March the 16th. And actually, this is a TO3 and a blue line buy here. And this has gone on to make about $1,000 so far, this blue line trade. All you guys who are trading the leader-follower blue line system with Jerry Winter will be very happy. You should have an extra about $1,000 per contract in your account from the US dollar blue line trade. But it's in fact this bar here, Dan, this is why the blue lines, it's not that the blue lines change, it's that the market moves on. So on that bar there, March the 16th, you have almost perfect target recognition. We had a Danielcode blue line at 95.575, and the low of this bar is 95.560. And this is a market that moves in 1/2 of 100ths. In other words, 560, the next one's 565, 570, 575. So that low there is only a few ticks away from the Danielcode blue line. That's very, very precise target recognition. That's what we're looking for. We go down here, we see here's our fast stochastic. All of these indicators, guys, are available to you with the Danielcode library. Those of you who are TO3 Plus subscribers, you get all this for free. And you'll see some of these on the chart. So there's our fast stochastic. It's oversold. No worries there. Here's the slow stochastic. It's oversold. And here's our momentum indicator. And it is diverging. In other words, if you can, shield your eyes from these next bars, that was the new low for the move. And if you go down and you look at your indicator here, your momentum study, it has not made a new low for the move. And that's the bar that actually sets up the blue line buy signal, which is valid for 3 days. And the market then goes down further. And it doesn't seem to recognize this 94,550 terribly well. It does a key reversal bar there, but it's this bar here, back on the Wednesday, that set up the blue line signal. So we post the blue line signal for Thursday, and it's valid for Thursday and Friday and Monday. And once it's met those conditions, it doesn't matter what it does in the next day or so. We wait only for the trade to be elected. There's the Friday, and on the Monday the trade is elected, by which it trades 2 ticks above the previous bar, which is right there, and then off it goes. So you got long here, and you're out. You're still in this trade actually. About $1,000 per one contract. Pretty nice, and that's how these blue line trades work. And because this is a blue line trade, we're using a trailing stop. We're not using a dollar stop. We're using a 2-bar trailing stop. This is our fast stochastic here. Let me spread this out a little bit for you. This is our fast stochastic, the 533. It's a Danielcode stochastic. It's slightly different to other stochastics, but we're going to use a 2-bar stop until this stochastic becomes overbought, which is this blue piece of this stochastic that's called stochastic K. There's one line's called stock K, the other's called stock D. And we're going to stick with a 2-bar trailing stop until it gets overbought, which is up here at 80%, and then we're going to go to a 1-bar trailing stop. So we're still long this market. We have the last 2 completed bars. There's 1 bar, that's Thursdays. This is the 2nd bar, it's Wednesday. Your stop should be below this bar, 2 ticks below this bar, and it will move up as this trade moves up. So that's a trailing stop based on bars, as opposed to a trailing stop, a dollar trailing stop. Okay, so folks, that's probably all we have time for today, which is probably roughly about half of what I want to show you. I did want to quickly just take you to the Danielcode website here. And I've asked Terry to switch off the pending and reinstate these signals so you can see what I mean, you new folks in particular. When you go to the Danielcode online, you'll finish up on this page here. This is the button for your free trial. Click that and get your username and password registered. Send your username to Terry. If you haven't had a free trial of Trade Navigator, we can organize that for you as well. Free trials run for 31 days with the Danielcode. We'll give you a free trial to everything. You can see everything that's on there, the TO3 signals, the plus signals, the trade program, the 4th seal, everything. The important thing is that people, Jim, you go to this page here that says trade program, and it looks like this. And down here, it tells you all about how to use this. You just have to read it, okay? And in here, you enter your size of your trading account, whatever it is, and you put in here the risk that you're prepared to run on each trade, and I recommend 2%. And once you've done that, you click this Calculate Contracts at Defined Risk button. This will all churn around in its servers, and it will bring up this page, which will tell you what each of the trades are for the day, whether they're a buy or a sell, and where you put your entry, where you have to put your entry. At this number, this market has to go to this number before it's valid. Okay? And this is where you put your initial stop. Over here, it's working out whether these are correlated trades or not. It knows which of these markets are correlated, and it's adjusting its suggested size of your trades here. As you get better, you don't have to be bound by this, but to start with, these are the sort of amounts you should be taking, and I'll show you why. Say we're going to take 2 of those, 1 of these, 2 of this. Let's move down here to our futures. We can take, corn's a very, very small contract. You can certainly take 1 of those. Sugar's also a very small contract. You can take 1 of those, and then you press this button again, and this will churn around in the servers, and it will come back and it'll tell you, you see what's happened over here, it's telling you what your total risk is on entry. So if you take 2 contracts and Canadian Chief, this is the mini Forex, your risk on entry is $250. If you're trading the normal Forex contract, add a naught, it's $2,500. Euro GBP, 97. And it goes down as you start trading futures. This is telling you that for for corn rather, the margin is somewhere around 1100. These change all the time. We don't update them all the time, but we do update them reasonably frequently. And your risk on entry is $250. You get to the bottom, it says, if all these trades are elected, which they almost certainly won't be, because 40% of these trades are never elected. In other words, the market does not go to this entry point to make them a valid trade. But if they were all to be elected and become live trades, this would be the risk in your account that you'd be taking. So that's all there for you, folks. And as it's Easter, I think we'll probably have to have a part 2, will we not? Because I have so much more material that I want to show you and talk with you about. So just please type any questions you might have in the questions box, so we can either deal with them now, or we can come back to you at another day when I get there. There doesn't seem to be any questions. Everyone's happy. That's it. Oh, I see 2 orders on corn. Yep, that's because I put that in. You can put in any number you like here. Let's go and find corn. Here's corn down here. No, it doesn't have 2 orders. What the program's saying is for corn, there was a buy for corn. This is yesterday's stuff, incidentally. And the buy point was 370.50. The market was suggesting that for this size account on this risk, you could take 1.6 contracts. I only put in 1, but you can put in 2 or 3 or 5, whatever you like. Press Calculate Value Sold. It'll spin around in the server, and it'll come up. And now it says, I thought I changed that to 2. Oh, I know what's happening here. This isn't going to be totally interactive because the day has gone. Okay, so you see it's still holding 1. It will, if you put in the number you want, it will calculate it, and it will spit out what the real value is. It's not doing that because this was set to pending a few hours ago, signifying that the trades you see up here, these are the trades for Thursday, they're over and gone. Terry reset it for me just so I could show you how it worked. So that's why that's not quite there. Okay, so that's why we have the 2 there. Thanks, Hank. You too, my friend. How do I subscribe to FracZen? John, we're not running FracZen at the moment. You can't subscribe to it, but start with the TO3 Plus signals, mates. That's what you want. Learn to trade those, start making some money. And let's talk about that when you've got a couple of months of that under your belt. And Augustus, how can you start mastering the strategy? Just follow what's on the website, Augustus, subscribe, get a free trial to start with, have 31 days free trial. See if this stuff agrees with you, if this is what you want. We don't do any marketing. We simply say, if you're interested, we'll give you a free trial of everything. You decide yourself whether this is what you want or you don't want. And if you do, then subscribe to TO3 Plus. Get started on that. Come to a tutorial if you're really serious about being a good trader, Augustus. Come to a tutorial. Janet, is 2% for trade, not the entire account? Yeah, it's 2% is the risk on each correlated trade. So if you put in 2% for CAD Chief, for example, it knows that's correlated. It might be correlated twice or three times. You can see you've got the Chief, which is the Swiss franc there. It's also down here. So there's two pairs in there that are correlated. There it is. It will take whatever that normal risk is. It will divide it by 2. If there were 3 correlations, it would divide it by 3. And all that. Akshay, thank you. Good, mate. Akshay, there's not much point covering Nifty, mate. In fact, I'm barely even doing signals for it now because I don't have many subscribers who trade the Nifty. Send me an email if you would. But there's, the only people who trade Nifty that really are people in India. It's a great index to trade. Boy, I'll tell you, there should be a lot of people trading it, but there aren't. And I certainly, amongst my clients, I have very, very few people who have any interest in the Nifty. So, I can't do a tutorial or a webinar, rather, just for you. I'd like to, mate, but it's just not enough interest in it. If you can find me a few hundred Indian clients who'd like to trade it, certainly I'll not only do it, I'll expand the coverage of it. Okay, we've got this. Everyone's happy. Guys, enjoy your Easter. Spend a few moments remembering what Easter is all about. And then we've got the joyous day of the resurrection on Monday. Thanks for your attendance. I know a lot of you are getting ready for holidays. It was great to see you all here with me, and I appreciate it. Bye-bye now.